thoughts? American Express and Capital One are surging today after getting an upgrade over at Baird, which says the recent underperformance in these stocks provides an opportunity to add exposure to the group. Joining us now on the newsline is the analyst behind that call, David George, Baird's senior research analyst. David, great to have you with us.
Good afternoon, Melissa. How are you?
Good, thanks. In terms of what these stocks have priced in, have they priced in more delinquencies? Have they priced in, what we've been seeing in the auto sector and in some other credit sectors where consumers are having more difficulty to pay?
Well, they've priced in a very significant downturn, in our opinion, probably a very severe recession, unemployment of 8 to 10%, in our opinion. So we think the group and the credit card stocks in particular are pricing in what I would call a very draconian scenario from a credit quality perspective. And with the panic selling, we think it's a great opportunity to start to add exposure to these stocks again.
Talk us through the exposure that American Express has to travel, David. I would imagine that, we see people traveling, and that should be, in theory, good for AXP.
Yeah, it is. It's, the travel and consumer, as you know, the consumer spend patterns are shifting from things to experiences, and travel, as you mentioned, Mel, is a huge positive for Amex. And Amex is probably the most levered company in our group of stocks to more robust travel. And that's a trend we think is going to last throughout the summer, into the fall, and into the end of the year. And expectations are quite low in the stock, in our opinion.
For AXP and COF, David, you say that these companies generate a lot of cash, they make a lot of money, and also there's this lever that they can pull in terms of pulling back on marketing spend. How much of a cushion is that, these companies' ability to pull back expenses?
Well, it's very significant. It's something that many investors are really not aware of. Both Amex and Cap One spend up to 8% of revenue in marketing. So when credit quality is softer, you tend to see these credit card companies pull back, and vice versa. So it provides an excellent lever, actually, as credit kind of moves up and down through the economic cycle.
Should one have any concerns about the credit profile of the Capital One financial customer?
Sure. I mean, Cap One is in the business of taking risk, particularly in the low end consumer. But if you're buying the stock at just over tangible book value, and 7 times what we think is normalized earnings and 5 times forward earnings, we think that market participants are getting paid to take that risk at these prices.
All right, David, great to speak with you. Thank you.